Hello, and welcome to episode 48 of the Wealth Amplifier podcast. We are honored today to have back for either the third or fourth time, Chairman and founding partner of Amplius, Sam Liebman, otherwise known as Dad. Dad, welcome to the podcast.
Good to be here, Matt. How did the next generation do this week in your office?
So what my dad's referring to there is two of his grandsons were in the office this week. My nephew Jacob has been interning for us for a couple of weeks, and my son Noah came into the office yesterday as well. The future is bright. I don't know if either one of them wants to go into this field or not, but the future is bright either way. So they did fine work.
They're fine guys, and I'm sure the future is bright for them, whatever they decide.
I agree. And so right now, what we wanted to talk about this time, because in the past, we've had this podcast on Father's Day and did more of general catch up, but would like to tap into your many decades. I won't go count how many, but many decades of market wisdom and experience here. And wanted to see if you could start with just some of the more interesting markets that you have witnessed over the years, for better or worse. And then I have some more refined questions from there. But the floor is yours.
Okay. So people will not remember, but I've said several times, my first 13 years in the business, 1969 to 1982, were a bear market in virtually everything. At stocks and bonds, all went down. Interest rates went to 16%. Bonds were down disastrously in market value. The stock market had a 13-year bear market with a couple peaks along the way. But if you were there during that period of time, that's why I called it my bear mitzvah. 13 years of down markets in everything.
And you mentioned clients being able to remember. Sometimes our listeners being able to remember. I feel like sometimes a lot of people, including people in our industry, barely remember how bad 2022 was, which was only 4 years ago. And you basically had that for 13 years to start your career. That was only 1 year.
That's right. 2022 was a down market in stocks and bonds. It lasted about a year, maybe a little less. That's true. And this was, there was a couple peaks along the way, but the Dow Jones was the big indicator in those days, and it had hit 1,000 at the end of 1968, I guess it was. And then from 69 to 82, it was down about 40%, as I remember it. It was not a lot, major bear markets.
So how did you handle that?
That was interesting. It was difficult to handle. Now, I had a background as a tax accountant before I came into the business, and the stock market was a disaster. Now, the bond market, to me at that time, was much more interesting for the clients I was developing and bringing in and so forth, because the long-term return on stocks that you hope for, that it's been for years and years, is give or take 10%. Now, we had AAA rated. AT&T, before it broke up, was AAA rated by all rating agencies. And I remember a bond, I forget when it matured, but I do remember the terms. It had a 5% coupon, and it was trading below 50, which meant that you had a current return of 10%. This sounds ridiculous, but it's true. It actually existed. You had a current return of 10%, more than 10%, and you would more than double your money just by holding the bond.
Wait. Hang on. So the price of that bond at that time was roughly what?
Price 48, 49.
And the actual coupon on the bond was
Five.
Five. All right. So just to put in context for our listeners, five has sort of been a magic number that a lot of wealthy people want. I've had, you have as well. Wealthy families tell us if we get 5%, now they'll often say tax free on munis, but just,
Right.
stay with
Right.
me on the on the story here. They'll often say 5%. If I can get 5%, who needs the stock market? I'll just ride it out and clip my 5%. So going back to where you were sitting there, you could get 5%. You could get 5% on something that was AAA rated, and not AAA rated like, for those that remember 2008, where everything that was bundled together, they slapped AAA on it and then it was a disaster. This was a legit AAA, effectively a national utility, if you will, at the time in AT&T. And as evidenced by the fact that it was trading at 48, that wasn't, nobody wanted it. I assume.
Right. Well, so new government bonds were coming out short term and out to, I think, around 10 years, could have been longer. They were coming out with a return of 15 or 16%. So to get a yield to maturity on a bond that had a 5 coupon, you had to get it down below 50 so that the total return, that's between, doubling your money on the
Yep.
value when it matures and getting a current return of over 10% every year, would equal what was being brought out in the open market at roughly 15%. So most in those days, stock trading had fixed commissions. And they were very high, as a matter of fact. And Charles Schwab came in years later, I think, 1975, and then the exchange agreed to negotiate all commissions, and then they started down and kept going down. But the point is that most of the people that I met who were in the business before I got there, the old pros, the guys who've been through the great bull market of the 60s, fantastic bull market, were pining for the old stock market they knew, which no longer existed. So it was funny. Bonds in those days, corporates that you bought in the open market, were about five. The commission was $5 a bond. This before fee-based advisory business that we do now. We don't do any brokerage business at all now. So in any case,
Correct.
it was $5 a bond. So I would be opening up clients and adding bonds, and the AT&T bond in particular, and municipal bonds. Municipal bonds, many times you could find them somewhere in the 8, 9, 10%. It sounds crazy, but it was true. AAA, tax-free munis, close to 10%. That's what it was. So anyway, I did discount corporates and I did munis. Now I remember, so as I got the orders in those days, there was an order, a teletype operator, and an order window and a slot. So you slid the order down the slot, and then the guy would, whoever it was, would type it to wherever the trading desk was that traded it.
Wait. Now, let me interrupt you for a second. This was, in fact, the 1960s and 70s, right? Not the 1860s and 70s.
Very good.
No, but also,
right.
I believe you told me that to get your orders in, I mean, literally physically to get your orders in, you sometimes had to like jostle for position, almost like boxing someone out in basketball or something.
Yes. So other people would be sending orders in also. The order typer, everybody say, get my order, get my order in. So at many times he didn't display the greatest decorum. And you would stand over watching him that he picked up your order and actually set it up. Because until he did, it didn't exist. So when I would walk up there with my orders, somebody would say, "Hey kid, what are you doing?" I said, "I'm doing some bonds." And they would say, "How could you do bonds? $5 a bond. How could you do it?" I said, "How many shares of stock you do today?" They would say 0. Well, I said, 5 times something is always better than 0 times 0. Gotta be.
So at that time, effectively, as far as getting through that rather epic bear market in multiple asset classes, you you essentially survived professionally in a way that helped your clients survive financially, and that is by going to the out of favor investment at that time. Is that fair to say?
Exactly. In other words, what you were trying for over the years in the stock market, trying for 10% return with risk, could go down also, you could get in AAA rated bonds, and you could get that 10% current and then have the bond automatically double by maturity. Now, of course, you could sell it along the way at whatever the market price was, but basically you had built in there a 10% current return, more than that, which was better than the average of stock markets over the years anyway. And you were guaranteed to double if you held it to maturity. And
Right.
it wasn't that far out. I forget the maturity. I think it was intermediate. It wasn't ultra long term.
Right, right, right. And so if I think about that, so that's 13 years, which takes you to 1982, and miserable period for the markets, but you survive, you more than survive. You thrive, your clients start thriving, and so on. But then you start in 1982 effectively what amounts to, with some interruptions, an 18-year period of an epic bull run, a good market for both stocks and bonds. So that must have been a heck of a psychology switch for both you and your client's mindset.
You are correct. Now I must apologize. There's construction going on in the unit upstairs. The drill is drilling the whole time.
I don't
I
hear a
don't hear
thing.
your
Oh,
words
oh,
exactly right. You'll bear with me. My hearing is great. It's that drill that's not great. Okay.
all good.
So actually, we had some exciting events along the way, and they were exciting in a negative way. So the 80s came along, and we had 5 fantastic years. I mean, not just good years, a crazy bull market, which was great. And we made a lot of money in that market as interest rates went down from about half. And they went from 15, 16 to 7, 8 on top quality securities. So obviously, the bonds went up in market value because when rates go down, bonds go up based on the new yield to maturity. And the stock market did great also. So there was the advent also of treasury strips and zeros. There were compound interest non-callable bonds, which gave you a terrific return in an interest rate, a down interest rate environment. So anyway, had 5 great years in there. Okay, so then we come up to 1987, and the market is going up. It's going up in every month, January, February, March, going straight up, straight up, straight up. Fantastic. However, the bond yields at that time were also going up from roughly 7 to 7.25 to around 10 to 10.25. So you had, if you put two charts together of the price of an average bond, it was going straight down to all of 1987, and the price of the average stock, or the Dow Jones or S&P, whatever you looked at, was going straight up. So you have this straight up and straight down going on during the year. Now, you know, Matt, and that I think most of our clients know that we believe that the bond market is the foundation for the stock market. So again, if you can get 10% in a bond, which you could by the summer of 1987, and you're just trying to get 10% in the stock market and with risk, but 10% in bonds, if you hold to maturity without risk, then it's hard to justify the stock price. So it so happens the 80s were great. We had fantastic trips they took us on. They had at Prudential Base, where I was at the time. That's where I started at Base when it was the second biggest house on the street. So, and then it grew with Prudential, and I think it took over EF Hutton. I'm not sure. But in any case, it was a major, major firm. Um, they hired a new CEO, George Ball, who had been the CEO of VF Hutton. He had been the president of VF Hutton. He got the CEO job, which is a step up. CEO also manages the balance sheet, decides what businesses you go into. President is a gung ho leader of the troops, and he was great at being a gung ho leader of the troops. So that in any case, they brought him in. He brought in a new investment strategy and research team. One of the guys was an economist. He's very good to this day, Ed Yardeni. So I used to go to meetings with him. He's a
Oh,
very guy.
he's been a big guy for what, 50 years in the industry?
Yeah,
Yeah,
they still interview him to this day.
yeah, yeah.
And he's had a very good record, very bright guy. They also hired a technical analyst. Uh, as I remembered, it was Joe Feshbach.
Uh,
Um, I, I don't know what his long term career was. I had no cut, but he was a
well,
very young
if
guy.
it was Joe, we wish him well. But yeah.
Yeah, it was Joe Israel. Anyway, he was a technical analyst. Might have been him, might have been one of the other four guys. In any case, and so we have a meeting all about investment strategy, asset allocation, the markets, and all this. So he had been to Japan, and he said that the Japanese were going to put 10% of their assets in the U.S. market and would go on up for forever to brand new heights. And he gave out a chart book, and the chart book had a chart of the yield on the Treasury bonds and the chart of the Dow Jones and S&P and Nasdaq, on the upside, and they were going in divergent paths. So at the time, so let's say that was 1987. So what was I, 43 at the time, right? So I was 43. Now he was in his 20s out there, I'm sure. So anyway, in front of the whole group, I had a good reputation. So I got up and asked the question. And I said, I see your chart book here, very nice charts. Um, uh, you see your bond page here where the price of the bond's going straight down and the yield's going straight up. And then you see the stock page also going straight up. How can how can that happen? How can that keep going on forever? That's when he told me the Japanese were going to put 10% more in the market, which I don't know, whatever happened to that. And then he says, I'm 43 years old. You old guys gotta believe in the future. You came out of bear markets, and all you think you're going back into bear. But you old guys, I was 43.
So
Okay,
what would he? I mean, yeah, what would he think now? We're almost 40
yeah,
years
look
on
at you
from that.
now. That's right. So, so anyway, it's interesting. So my old partner Ed Jower, who's now 97 years old and in fine shape.
He just visited the office last month.
Oh, he did, yeah, he
Yeah, yeah.
did.
No, he's
Great.
Ed's doing great.
Ed's doing great. So he and I, after the business trip to, it was to Southern California, some nice resort right on the Pacific. So we went to Santa Fe, I think it was.
Yeah,
I'd
I was
never been
just
there
there.
before, and we ended up small point having nothing to do with the markets. We ended up sharing a duplex with Robert Redford, who was making a movie there.
Huh.
And Ed's wife tried to get an autograph, and he didn't give it to her. He was very nasty. Okay, so anyway, so I decided when I came back, which was around or mid August, late August, somewhere in there, that I was going to get my clients reduce their exposure to the equity markets. And I had a lot of clients. And of course, the chairman's council trip was the top 1% of the guys in the firm. So obviously, I had a lot of assets under management and clients. In those days, it was brokerage. So you had to call everybody. So I was on the phone all the time, reducing stock market exposure and then putting it temporarily into money market funds, which I think were yielding around 7 or 8 at the time. The bonds were up to 10, but they were seven to eight.
Wait,
So
so
I took a
at that time, just to recap here, markets, I assume, are at all-time highs for that moment or thereabouts.
yeah.
Um, and as you said before, traditionally, average market returns are 10% per year. They almost never do they hit that number. It's usually way less, way more, but that's the average. And you're sitting there at all-time highs, and you can essentially sell that position and go into what effectively is cash, money markets, something like that, or maybe some short-term bonds and get almost that 10%, like 7 or 8%, you said?
Yeah, I think that's where they were. And so I did that. So I raised cash in all the accounts. You had to call everybody, and if somebody was a true believer and wanted to stay in, then they said no, so they stayed in. So, but most of my clients followed the advice. We reduced. We tried to get everybody down to about 50%. Now you got to remember that. The percentage of assets in retirement plans as part of an overall uh, portfolio were a lot less than they are now. It's much easier to take money off the table in retirement account where you don't pay tax on the gains that you're taking. But in any case, we did it. In other words, any gain is better than any loss, right, Matt? As
Who could argue with that? Maybe
yeah,
an
right.
accountant, but I don't even think they would argue with that.
Right. So we did reduce that. And so that was around the peak. It was in August sometime, as I remember it. And then in October, this is very interesting. In October, the Friday before the crash of 87, I believe it went down like 5 or 6%. And so happens we had an investment conference in New York, and we were there during the weekend, that is. And the analyst at the time, it was not the same guy who was out at the meeting there. The analyst in the office was an old timer, and he said it looks really bad. Now, the whole place erupted, cursing the guy out because he was bearish. The guy was telling the truth, of what he thought. And I
Let,
remember, and I'm thinking, yeah, you're probably right. And it looks terrible. But but they didn't like it, and they told some executives told the guy he was too bearish. Ridiculous. Okay. So then comes the Monday of the crash of 87. And of course, the bottom line is in one day, it went down like 22.5% or something in one day. I believe that was the biggest percentage decline ever. Of course, we used the Dow Jones Industrials, even more than any one day in the crash of 29, I think. I wasn't there for that. Okay.
all right, just making sure.
No, right. So, in any case, now what is happening is that there are big stocks that are not trading. You can't get a trade off. There was panic, crazy. It was all, on the NYSE, millions of traders, not electronic the way it is today. You couldn't get a trade off, except I figured that if I were doing mutual funds, which are priced at the close every day, that the mutual funds might give you a trade. In other words, so if they had Polaroid with a big stock in those days, and let's say that you couldn't trade it, but the quote was 100 to 110, for argument's sake, they would artificially settle their net asset value as if the stock were 105. And that proved to be right. That's the only thing you could trade. And that day, so Ed, we mentioned Ed again, but my old partners at the other corner office, he's looking like the world is coming to an end. Now, he was born in 1929. Okay. He's looking like the world is coming to an end. Okay. And he comes out of his office coincidentally around wherever the close was, a half hour before the close, I come out also, and I have about an inch thick of orders, paper orders, to buy various stock mutual funds, which I had liked, which had done very well for everybody in the previous 5 years. They had proved they were very good managers of equity money. And so I had I don't know how many funds, but I had mutual fund orders in the buy equities. And what I did, normally I do things in threes, as you know, I did them in quarters. And I don't know why I did at the time, but of the money I had raised, I put a quarter of it in that day. Then I waited, and then you got some bounce up, and then you had another decline. I put another quarter in. Then you had another bounce up, then another decline, the third quarter. And then it's ringing a bell that it was December 4th. I'd have to look this up if I could get it. That was my last quarter where I had all the money that had been in the stock market taken out back invested in at that time. Now, of course, at that time, everybody was scared. Nobody wanted to do anything. But if you had been out in advance so that on the money that was not negatively affected, it's a lot easier to have guts to buy at that time. You know, if you had
And I
been
bet,
down and asked to put more money in.
and I bet at that time, you didn't have to box many people out to get your buy orders in. It was probably a little bit of a ghost town by the trading desk.
It was, and nobody could believe it. So we had private offices in the back corners, Ed and I, but there was a big boardroom with a lot of guys out there, and that's where the order window was. And they were all looking like somebody shot their dog. And there I was walking in with the orders, and I don't know if they thought I was smart or nuts. but there you are.
So I want to, I want to bring this to the closer to the modern day, because there are any number of, you have the crash of '87. I can speak from experience because I was in the business then. You made some similar moves in both directions around 2000 and 2008, but I don't want our listeners to think that A, this is easy, or B, that this happens all the time. We're talking about three or so incidents here over 50 some odd years. So I guess my question is, what we can't, let me ask you a question. I feel like a lot of times people are trying to predict the next crash. To me, the more fruitful thing to do is try and figure out, if it does happen, what are we going to do about it at that time? But I guess, so for you, having been through many of these, is that the way you view it? Or do you think there is some ability or value to trying to, quote, predict the next crash? Because in effect, in '87, that's what you did.
It's what I did. Now, there was not another move that obvious to me since the crash of '87. Now, of course, remember, that was the biggest down day in the history of the market, and it hasn't been repeated on any one day at this point. And that was caused by the fundamental, you can think earnings are good, they're bad, the government's good, it's bad, taxes are going up, they're going down. You can think anything you want to think along those lines. But when you see a stock market going straight up, I don't know if it was 20, 30, 40% in that 8-month period, and a bond market going down roughly the same, like two mirror images, that means you have a building, in effect, which is a gigantic skyscraper with like a 1 2x4 as your foundation.
A toothpick.
Bound to fall over. Okay.
Yeah.
That has not happened again, not now. So that has not happened. There are methods by which you can calculate these things. The best thing anybody can do going forward or now is control risk. So in other words, if you know that a certain account of yours or all your assets that you've decided, for argument's sake, to have a balanced account, 50 in stock and 50 in bonds, commodity, whatever else you want outside of stocks. So what you can do, of course, is when you get in a bull market, rather than getting gung ho and say, oh, it's going up, it's great, I'm making a lot of money, I'll throw more in. That is just the time to get back to your normal allocation. So if you were 50 and your 50 got to 55, you sell some to bring it back down to 50. You're not outsmarting the market. You're just controlling risk, your risk. You've already said that your risk is 50% you would take in the stock market. That's a given. Therefore, when it gets to 60, you bring it down to 50. And and that has nothing to do with where the market is at all.
Right.
Obviously,
That's just ongoing discipline and risk management, or as a client of ours who will remain nameless for privacy has said, what your dad told me early on was when everybody wants something so badly, give them a little bit. Meaning
that's
if you're
true.
going up a lot, sell a little bit. If and the market goes down a little bit, they want to get rid of it so badly, take a little bit.
Be a nice guy. Give them what they want.
Right, right. So let me ask you a question, because I know this question is going to come to us for after people listen to this. What parallels do you see today, where we're again near an all-time high, to any of those past episodes of your career, be it 87, 2000, 2008, and how is this time, not a parallel to those? How do you feel about that? Because I'm sure we will get that question.
Okay, let me go back for a second before I go to that question. So, in your previous occupation as a quantitative analyst, CFA, very fancy, all that stuff, you had an asset allocation model with that firm that you ran. You ran the model. You also ran an interest rate model. Now, going into January 1st of 2000, your model had the market uh, uh, counseled to reduce equity holdings to 50% from wherever they were. And that model was mainly based on stocks versus bonds. So what I'm bringing out here is he went into 2000, it was not nearly as extreme, but you did have bonds in the 6-7% range, and
Yep.
you had stocks selling some at like 34 times earnings. Based on 6 or 7%, the inverse, they should have been selling at 16 or 17 times earnings. They were selling at double that. And that market, from top to bottom, where it bottomed in 2002, went down 50%. Okay. So those are the things you can watch along the way. That's extraordinary. That doesn't happen. So right now, I see nothing on the horizon that is anything like the leading into 2000, or it's certainly not leading into the crash of 87. One would hope that the '08, which was the other big, tremendous bear market, went down 57%. So we had 9 years when the market was down over 50% net for 9 years. And of course, that followed the great '90s where it was up through the roof. This is the way these things go.
Yeah, that was my first 9 years in the business. That was a lot of fun too.
Yeah, your first thing, yeah. So yeah. So we know how to handle a bear. Do we know how to handle a bull? Yeah, I think so. Anyway, so right now, the PE ratios are in the low 20s. If you look at 10-year bond, you're trading around 460 today. And based on that, you're about fair value versus bonds. The other factor, which is going on, is that earnings are coming in better than expected. The earnings are great. Now, everybody can argue about the country. This one hates that one, the left, the right, the extremes, and all that. Hard to argue that American business isn't functioning exceedingly well. So the profits are excellent. The balance sheets are stronger than ever. So now, a 5 to 10% sell off, even a definition bear market at 20%, certainly possible. If you ever got to those numbers based on these fundamentals, that would be more a buying signal than not. So in the meantime, we have been sticking to what the risk profile of our clients should be, and we keep chopping that down as it goes up above their level, and that is giving us buying power that would cushion a decline in their total value, one, but two, give us some blasting powder should we get down 5 or 10% below their level to add into the market.
Right. So in effect, as far as market indicators go on the way in, and then we'll revisit again this on the way out. But on the way in, what one of the things we always tell clients when they talk about the levels of the market, and a lot of times people get anchored, which is sort of a behavioral finance term, to what the market has done recently. So it's gone up, therefore it can't go down. I mean, excuse me, therefore it can't keep going up. This type of thing. But what is more, I guess, fundamental and data driven than that is the two biggest factors, generally speaking, are earnings and interest rates. If companies keep making money, that's good for stocks. And if interest rates stay, let's say, on the lower side and the more stable side, also good for stocks. If either one of those two things starts going away from that, whether you see rates spike up a ton, where all of a sudden you're back to your 87 scenario or something close to that, or earnings just stop growing or even start declining, those are flashing warning signs for stocks. But until or unless we see that, again, 5, 10, 20% sell off can happen for good reason, bad reason, or no reason. But as far as the big one goes, the ones that you're talking about, 87, 2000, 2008, anything's possible, but it seems unlikely with earnings as strong as they are and interest rates as stable as they are.
Yeah, I would fully agree with that. And the other thing we do and one can do in this situation. So let's just, there are 9 style boxes. What I mean is there's large cap, mid cap, small cap, and there's core, value, and growth. So there's 9 style boxes
In the US stock
US.
market. Right, right.
Yeah. And of course, there's the comparison of the markets outside the US, the foreign markets, and the US market. So when you see times where one segment has outperformed everything, and if you've ever seen what they used to call Callan charts, I don't know if Callan is still in the business, but in any case,
My guess is they were acquired by somebody at some point, but maybe they're still around. I'm not sure.
yeah. So there's style boxes, and they're color coded. So you'll see that the bright green, like at the top for 3 years, and then you'll see it at the bottom for 2 years, and you'll see the orange at the bottom for 3 years, and then at the top for a year. So anyway, what I'm getting at is, as you get maybe it's rational, we would call it a rational outperformance of a certain area, good to chop some off of that and add it to some of the areas that have not participated yet. Again, that's a risk control mechanism. So when you're getting out of, let's say, a large cap growth ETF, reducing it, not getting out of it, and you see small cap value has gone down like for 8 years in a row or some crazy thing. So you add some that way, and therefore you cushion the decline, the future decline, which is inevitable in the top item. Also, you don't get rid of it; you just reduce it.
Right. So again, another way of, to summarize, if there was one thought, one trait, one word, would sort of be discipline. You have to
That's
have
the word.
Yep.
That's what I was going to say. Discipline.
Right. Have to have discipline. Now, I do want to go back and we'll wrap up here in a minute, but I do want to go back to something you were saying about the strategist. I think it was the Friday before the crash effect. Oh, not the strategist. I think it was an older analyst, you said.
Yeah, right.
Said this doesn't look good or this looks very bad. And he basically got yelled at, cursed at. Management was coming down on him. I will tell you and I can't say if it's still the case now because we've been independent for several years and we talk to strategists, but I'm not at one firm. But that was going on right up until right through the last decade or so. I remember being in at a conference in like 2010, 2011, somewhere in that range. And a strategist got up and spoke and had a fairly bullish speech And the first question, it came from the audience. Before the question was asked, he said, "Thank you for being bullish." As if like this guy's job was to tell you something to make you feel better, as opposed to tell you something that was, that would be right. And I saw
Right.
I've seen a number of those over the years. It's a and it just, is a cautionary tale that you have to at least take what pundits are saying with a grain or a pound of salt. Um,
At one of our former firms, that had, I don't know whether he was bullish or bearish, but he was right. I just saw him on TV. It reminded me. I think it was David Bianco.
yeah, he nailed it, but he was wrong for about 3 weeks, and they pushed him out. And he was like legendarily right on his calls.
Yeah, it was a fantastic call, but
Yeah,
the guy wasn't right that minute. I said, "Oh my!" It
hey,
was.
he's a
I
smart
had
guy,
to
but
see
he's
it.
doing fine for himself. It looks
Yeah,
like
he's
on
doing
TV.
fine, but
Yeah,
but
yeah.
that was preposterous. I agreed with him, and it didn't happen right away. As it happened that, listen, we try to be right. We can't always be right by the minute. So this guy was as right. I forget whether it's a bullish or a bearish
I
call.
think I think he was. It was actually I think he was bullish, and I want to say it was 2011, 2014, one of those years, and the market went into like a bit of a rough couple quarters, and it was a blip. It wound up being totally fine, and he was dead right. But but but
Right,
but but
right.
they didn't
But
like
I
that he
mean,
was wrong for a couple
by
quarters.
the end of the year, he was gone. Yeah.
Yeah. And but so let me ask you for a next to last question. You just have to clarify this for us because Aaron, Pat, and I just recently recorded episode 47 of our podcast, and we said on there we were using the term wirehouse to describe old Wall Street firms, which is sort of a commonly used term. Can you define why they call it a wirehouse? What that actually means, the origin or history of that?
Repeat that question, would you, Matt, please?
Yeah. So we used on a
Oh, the
recent
Wirehouse question.
yeah,
Yes.
Wirehouse. So what is
Okay.
a wirehouse? Why do they call
Okay.
Wall Street
Okay.
firms a
Okay.
wirehouse?
So it was, there were firms that had seats directly. That was the whole firm. They had a seat on the NYSE. That was the firm. That was where their guys were. Okay. Then the firms branched out and had offices around the country, as we were in Philadelphia. Now remember that where I had to put the orders in, down that slot, right? With all the jostling going on to get the order in. That guy, that room was called the wire room.
Got
And that guy had to send a wire to the NYSE or the bond trading desk or wherever in order to get it done. In other words, so we were not right on the floor. These were wire houses, and that's what like Merle and Bache and those various firms were the original wire houses. Now, it's pretty irrelevant now because most of the trading gets executed in less than a second. I think it's less than a second. I see them on the screen in 2 seconds,
Yeah.
yeah, electronically. So no need for the wire. When we put in orders right from our ThinkPad, it goes right to execution, gets done right away, and that's it. But those were the wirehouses, the Pace and the Merrill Lynches of the world.
Well, so I was right. I said on the podcast. I'm not exactly sure, but I'm sure my dad knows the answer. So
But yeah, I worked at one for many years. Yes.
yeah. All right. So closing question. We'll close where we started. Which I was not planning, but but let's bring it back here. You mentioned the outset that both of your grandsons, not to, were in the office this week, um, and you also have two other grandchildren, and many of the other people listening have children and grandchildren. So you've seen a lot of different things in this industry. You had three different big firms, and then independent over the last 5 years or so. What is your long-term level of optimism or pessimism for this industry? For those whose kids or grandkids are listening, or maybe mid-career switchers, there's a lot of talk out there about AI replacing people in a lot of industries. So, what is your long-term outlook for this industry? Wealth management, we'll call it.
Well, and I'll say this for the long term of the industry, and I consider myself to have a long term career yet in front of me. So
Good.
that's how we're going to handle this. Uh, uh, I am positive, and I'm not always positive on everything. There are things I'm negative. I
Yes,
am
I'm familiar.
positive. Yeah, I am positive on this industry in this regard. You can have any computer model you want, pick your stocks, do whatever you want for you. You can have that all day long. Financial assets are going to keep growing in this country with the population. The baby boomers are all retired now. They have tremendous assets, which are going to be passed to the next generation. Now, so you can plug in anything, and if you like a computer screen much better than you like people, that's great. You can try it that way. When you get the tough times, either too crazily bullish or too wildly bearish, when you get that time, and I'm not saying that all financial advisors can do this, but a good financial advisor can help an investor manage their emotions and not make rough decisions. A computer model can pop up and say, don't do this, but it's not the same. So I think the financial assets in the country will grow tremendously. As I said, business is operating more efficiently and more solidly, balance sheet than ever. There are more people now. I think about 70% of the public. There were never any numbers close to that when I started in the business. Might have been half of that. 70% of the public, one way or the other, through 401k or their own accounts, whatever, are in the markets, and they are benefiting from the stock market doing as well as it has, the portion of their assets that are in stocks. So it's not like it's just business is doing well and people aren't. 70% of the people in the markets, and they care about what happens in the markets. So and so I believe that the future is positive at this point. You're going to have sell-offs. That's what makes a market. That's what makes the ups and the downs. That's what you got to take in order to build a good financial balance sheet. And I think you'll be able to do it. Now, as far as the parts of the business, I believe that the RIA model that we're in, that's why we went to it, because we think it's the best, strictly fee-based, no markups, no spreads, no nothing. The better the client does, the better we do, and vice versa. And so we are on the same side of the table, not like in the old brokerage firm model.
Yep. Fully well, you don't need to convince me. Fully agree, but that was a
right. You led the move, right?
well, so with that, we will wrap up. Thank you very much to Sam Liebman, founding partner and chairman of Amplius. Dad, thank you very much.
My pleasure. Thank you, and thank everybody who's listening.